Thank you, you guys. We were in for an awesome treat tonight. Jason and Brad are both great teachers on venture capital. They got me to understand venture capital, and I was an anthropology student, so this should be good. Brad Bernthal is an associate professor here at the law school. He teaches around entrepreneurship and innovation policy. He also leads the Entrepreneurial Law Clinic, which is an amazing clinic that we have here in the law school that provides free legal services to local startups. So that is a really cool thing that we've got going on. He's also a tennis master. I don't know, that's not a term, but he is really good at tennis, and he is a very, very overly excited. He teaches. You're a coach for your like 5th and 2nd grade daughters' basketball teams, and he's way too into it. But that's great. Jason Mendelson is a co-founder and a managing director of the Foundry Group, which is a venture capital firm here in town. Before he did that, he was the general counsel and managing director at Mobius Venture Capital. He was a lawyer in his previous life, and he is a drummer in several bands still, which is pretty cool. So I will turn things over to them in just a moment. I do want to highlight a couple of great events that we have coming up in the next couple of months that I hope you guys will get on your radar. They're also on the back of this handout that you got in the front. Coming up on February 18th is an Entrepreneurs Unplugged session with Larry Gold. If you haven't been to Entrepreneurs Unplugged before, we think of it as the Actors Studio entrepreneurship style. So it is entrepreneurship storytelling. It's a really great way to come and learn about a local entrepreneur, and Larry should be an engaging speaker. That's in this same room on February 18th. And coming up on April 22nd, we're going to have the championships for the New Venture Challenge. And if you're not familiar with the New Venture Challenge, I'm the director of that as well, and that's our cross-campus entrepreneurship championships. Again, it's in this room. You'll get to come and see the 6, 7 coolest new venture ideas, new business ideas that are coming out of CU this year. Great way to come and see some student entrepreneurs. So that's April 22nd. Without further ado, I'm going to turn things over to Jason, and he'll get us started.
As I'm good doing delegating, I'll turn it over to Brad. Have fun, Brad. See you later. I'm going to go get a beer.
All right, how are we doing on sound? There's nothing worse than sitting in here and not being able to hear somebody in the back. Is it all right? Okay, great. So first of all, God bless you for being here. We are trying to put a course that we've been teaching now for 6 years. Jason's written a book on it. Jason's got an extensive blog that he's co-authored with one of his partners on it. And we're going to try to do this in about 50 minutes, which means it almost certainly will fail. But nonetheless, we're delighted to spend the night with you here. Additionally, I want to give a special welcome to my wife, Andy, and Jason's fiancee, Jen. So when we do fail, Andy will not be surprised I'm embarrassing myself up here. And I want to give a special welcome to people who are here who came through our venture capital class over the last 6 years. Anybody, alums who came through the class here? Awesome to have you guys here, and that's very special to us. And finally, for those of you who have been to Silicon Flatiron stuff before, we are so lucky to have an A-plus team across the board. You saw Mystery. Anna Noskazes, our program director. Cactus is here helping with the event logistics. And then Jamie Stewart's not here, but always behind the scenes. Please help me give a warm thank you to our Silicon Flatiron team. Finally, on your programs is listed our supporters for Silicon Flatirons. And we couldn't truly do this without you. And I am pleased to relay that so far in our 2013-2014 fundraising cycle, we are already over our record amount in previous years. So many thank yous to the community and many of you in here who have gotten behind it. And please tell the sponsors, thank you. Jason's the chairman of our advisory board. I want to invite you to say a quick word before we get going on that, and then we'll get going on the course.
Yeah, so to echo Brad, thank you for those of you who paid money to come tonight. Thank you for those of you who didn't, who are here supporting us. But the money allows us to do things like this all over campus. allows for him to have a job here at CU, which I think everybody knows how important that is. Really sincerely, please give what you can. Because of that, unlike past years where it was all free, we could get up here and just blather on for several hours about tennis and football and other crap like that. We now work for you. So, because of that, here's some ground rules. We're going to try to do a lot in an hour. If we get going, rolling too fast, raise your hand. If you got a question and it's relevant, it's on point. Don't ask me like something that's not relevant. We will stop. We will get everybody caught up. If you're wondering, oh my God, I'm in this big group of people, I'm scared to raise my hand, what if my answer, or what if my question is stupid? I promise you this, whatever question you have, he doesn't know the answer, so it's not that stupid. So stop us at any time. What?
That's nice.
All right.
That's nice. Good way to get started.
With that, why don't we get going? You want to talk about the dance card, buddy?
Yes.
All right.
What we've got, we're going to try to do 4 things tonight. First is the existential question. We'll talk about some context around the world of venture capital, and in particular, why do we have venture capitalists between the sources of money and the startups? And that's important to understand in terms of what problems venture capitalists are designed to solve. And at the end, we'll come back to the future of venture capital, where there's been a lot of questions, and thinking about the new problems of entrepreneurial finance and whether the traditional VC model is going to continue to serve to solve those problems, or whether we might see some new models emerge, and we'll talk a little bit about that. Second is, okay, that's the context of venture capital. Now, should I be looking to pursue venture capital? What kinds of companies are fundable? And if I'm interested in pursuing venture capital, what are some things that I should be thinking about in order to position my company, my startup, for the best possible chance to land venture capital? And then third, we'll get into some of the mechanics. So, okay, we've now decided we're going to pursue a VC round. What are a few of the mechanics? We're not going to get deeply into the term sheets. We'll talk about some sources that you can go to in terms of VC terms. Happy to answer questions that you have about terms, however, but we'll get into some of the mechanics. And then finally, we'll do a few hot topics that I'll tee up for Jason to opine upon, and then open it up for questions, as Jason said, in terms of ground rules. Please jump in. Before we do classes, we often talk about Al Michaels and Chris Collinsworth as maybe our overly inflated view of ourselves. You will see that I will do a lot of play-by-play. He will do a lot of color commentary, and that's kind of the format that we'll do.
You know I prefer Pat Summerall, John Madden, right?
And because one of them is
drunk.
Yeah.
Right. Yeah, very nice.
We'll do a quick intro. We've heard some of this. Things you want to highlight?
Yeah, nothing too special. That's my favorite instrument, accordion. It's not really. I'm from the Foundry Group, a book called Venture Deals, Be Smarter Than Your Lawyer, and Venture Capitalist. If you're looking for stuff on terms, that'd be a good way to look. Also a former software engineer. Plug for my band Legitimate Front, Spotify, at a store near you. And there's my Twitter handle. Brad?
I work here, and I like tennis. Let's
Got
get
it.
going. Okay.
All right.
Existential question. Let's talk about how VCs fit into the world and why they exist. And Jason, I'm going to invite you to talk a lot more about the investors first. But note that the VC is a specialized intermediary. That is, they perform a function to connect up investors at the far left to the startup's bottom right, and they are performing a role as a specialized intermediary. A key question to ask is, VCs cost money. Jason does get paid. Okay? Why do we have a specialized intermediary? It would be much more efficient, or at least cheap, to just have the investors directly invest in startup companies. And so as part of this explaining why VCs exist on the front end, let's talk about some of the problems that they solve. At the outset, oh, by the way, I call this the VC sandwich, although you've kind of rearranged this so it's less sandwich-like, because I like the idea that Jason's in the middle of something. So anyway, all right, so VC sandwich. Over at the investors, talk about who the limited partners are to a typical VC fund.
So first of all, you're very generous to call me a specialized intermediary. Aren't I just a highly paid middleman? Way to think about this is I'm a real estate agent effectively, right? Each one of you could go buy a house directly, but you don't because you're scared, the seller's scared, and somebody needs to hold all of our hands. Well, it's effectively what I do. So the investors who invest in venture capital funds are called limited partners, and these are, university endowments, they're banks, they're pension funds, sometimes there's high net worth individuals. Usually they're entities, but they're people with money who say, hey, in my portfolio, I'd like to own a part of startups. Problem is they don't know where to find the startups. They don't have the expertise in determining what startups are the good ones to invest in. And so they hire a guy like me, which may seem surprising after you know me. After about an hour, you'll say, really, that idiot can raise money. But yes, it is true. I actually have conned investors into giving us money, and I use that term loosely, that we invest directly in the startups.
Let's talk a little bit about the structure of the relationship between the investors, the limited partners, and the VC fund. In particular, the fund life and how long that's going to go on.
So this isn't the stock market. If you invest in a venture capital fund, we have just gotten married. And I say that because the average U.S. marriage lasts about 8 years, actually a little less. That's why there's a 7-year itch. The average venture firm is set up to last 10 years and usually lasts 13. So it's a very large commitment. The venture capitalists who invest in the startups, usually that relationship's a little shorter. It's usually between 5 and 9 years from when we invest to when we get our money back, or the company goes bankrupt and I get nothing back. But the ultimate resolution usually happens in 5 to 9 years. And the idea is that these are long-term relationships on both sides of the sandwich. I guess you'd call me the Oreo stuff, the Oreo cookie. Now, the investors, once they give me the money, they do have certain rights if I'm going to do bad things. I'm going to, I can't invest the money in Brad's wife's dry cleaning business that she's going to start next week. Sorry, Andy, I don't mean to out you here. I have to invest in tech companies in my fund. I have to do certain things, but they have no control over what companies I invest in. I have the unilateral ability to invest in anything that I want.
All right, so let's unpack some of the value on both sides. If you are the startup, in addition to capital, which is the most obvious need that a startup will be looking to from venture capital, what other services and value adds might you be looking for? Jason, you want to talk about some of the different functions that a VC will typically be performing?
Yeah, well, actually, I'll be a little cynical and say these are the functions that VCs are supposed to perform. If you go to my blog, jasonmendelson.com, I recently posted what I call a VC code of conduct because I was so disappointed with so many VCs don't do these things. I decided to go on a rant. So if you'd like to see me pissed off, you can go to my blog. But in general, what we're supposed to be doing is we're supposed to sit on the board of directors. We're supposed to help these companies with their corporate governance, know how to run a company. I've been involved with approximately 400 companies at this point in my career. I might be able to bring some expertise to a startup company that doesn't have as much experience. I help hire and find folks and network, my network to get people into the company. I help them with HR issues. The big thing I do is company strategy. And one of the biggest parts of company strategy is being a sounding board of the CEO. As I like to say, being a CEO is a terribly lonely job. You have nobody to cry with at your own company. And that's hopefully what the relationship I have that's open, honest, and transparent, that I can help CEOs through their hardest problems.
Talk a little bit about the role of reputation in this. And in particular, so we've talked about that a VC is going to bring capital to a startup, that a good VC is going to perform a variety of services in addition to that capital. Okay? And there's also a reputational component that in our course we call certification value. Talk a little bit about that, and then how the certification value gets paid for by the startup in terms of a discount to high reputation VCs versus lower ones.
So a high reputation VC can act as a halo for your company. In a perfect world, a customer says, hey, I'd like to do business with you, but you're a small little company. You're sure you're going to be around 6 months from now? And you say, oh, no, I'm funded by the founder group. And they go, oh, we've heard of those guys. Okay, cool. We'll do business with you. It works the same way with hiring. How do I know I'll have a job in a year? But it also really helps with fundraising. Just today, I had a discussion with a company that had no luck fundraising and is now starting to get a little luck, and we've decided to invest, and now it's leaking out that we're going to invest, and now they have more money than they know what to do with. So these reputational halos are very important along a lot of metrics, and so if you're going to take venture money, it's not just the money, it's not just the help, but the reputation matters as well.
And to put this in an academic frame, there's research by SU, HSU, that suggests empirically high reputation VCs get something in the ballpark of a 12 to 15% discount on valuation with startups. That is, everything else equal, Jason's a high reputation VC. I'm a low reputation VC. This is actually the way it would work out. I'm a professor, right? That I would have to pay at least 15, 20% more to get into the deal from the startup's perspective than Jason would. Okay, so reputation and this halo effect certification is enormously powerful in this area. Let's go back to the top of the VC sandwich in the perspective of limited partners and ask, why do limited partners want to work through a specialized intermediary such as a venture capitalist?
Or in English, why do investors want to work through a middleman to invest in startups?
And here, I think you want to back up and let's talk a little bit about, take one of your limited partners and talk about the asset allocation strategy that they're going to be pursuing, and how does VC or alternative assets fit into that larger picture?
So we can take UTEMCO, for instance, University of Texas Management Companies. They're our largest investor. It's public information. They invest in a ton of different assets. So everything from real estate to foreign markets to equities to gold to who knows what. And they're pretty typical that only about 10% or at no more than 10% of their assets are in what's called private equity, which includes venture capital, includes hedge funds, other sorts of activities. So despite venture being responsible for, the latest numbers are 11% of jobs and 22% of GDP. So venture-backed companies represent 11% of jobs and 22% of GDP in the country, the last study. It's actually a really tiny industry because the investors who are investing in venture capital, because it's so risky, we'll talk about later, but if half of my companies aren't zero, it's a really successful fund. So it's kind of like baseball. If you can hit 300 with some power, you're a superstar. But it's incredibly risky. So they allocate small amounts of capital, but when things go well, you can make a huge return on it.
And let's talk a little bit about that. So I've got this somewhat wonky language that we're talking about inefficient markets where there's information gaps which can be exploited by experts. And when we're talking about alternative asset classes, this is the description of what we're referring to. When we say inefficient markets, we're talking about markets in which there may not be ready liquidity. That is, if you want your money out, there may not be a stock market that cashes you out immediately for a sale at fair market value. Information gaps. Think about the nature of a startup, right? That Jason's taking a look at a very early stage company, say Brian's, you're often talking about very limited revenues or pre-revenue. Technology that's trying to do something extremely innovative. Maybe the technology works, maybe it doesn't. Founding team that has various levels of experience. And so there's a diverse number of outcomes that are all highly uncertain, okay? And associated with that, there's not a lot of public information, either because Brian's not making it public or because Brian doesn't know either. Right? And so there's massive information gaps in these information markets. What does that mean? It means that this is a good place to more or less lose your ass. It's very easy to have opportunistic behavior that exploits investors and ends up being a waste of their money. It also means there's terrific bargains and terrific value to be created. Okay? And this is my golden moment. Are you ready for this?
You know what's about sushi and burritos?
Sushi and burritos. Okay?
I'm going to go take a nap. Actually, I'm going to go seat some people who need seats. Why don't you go ahead, talk amongst yourself.
Well, get him a sushi.
Welcome.
Get a little
Please,
sushi, give him a burrito.
Sit
All
down.
right, so here's the thought experiment I want you to do. And that is, think about the best burrito you've ever had in your life.
Just come on down. It's all right.
Okay? All right, think about the worst burrito you've ever had in your life.
Seats are somebody's down here. Come on. I'll get you a good seat. Come on, I know a guy.
Now think about the best piece of sushi you've ever consumed and the worst sushi you've ever consumed. Okay. As you think about variance between the best and the worst, is there more variance in your conception between a good burrito and an awful burrito? Or is there higher variance in good sushi versus bad sushi? Okay. I see you laughing. Why? Give me your answer. Yeah. Why sushi? Good.
Sushi.
Yes.
Because, I don't know, sushi can be horrible.
And if it's horrible, there are consequences. consequences that can linger. Burrito, good burrito, great burrito, bad burrito, And I'm sorry if you own a Mexican place in town. If so, you're happy to attack me afterwards and explain why there's higher variance than appreciated. But as you think about asset classes, and going back to the perspective of the limited partner, think about it in terms of sushi and burritos. Okay? As you are Utemco, deciding how am I going to distribute my money, when it comes to a market like bonds, the asset manager just doesn't matter very much. It's more like burritos. There's not a lot of variance between the high performers and the low performers. Public stock markets, which are relatively efficient markets with far fewer information gaps, okay, still more like a burrito, a little bit more variance. And to put this in perspective, the difference between 25th percentile performers, high performers in the public stock markets, and 75th percentile performers, relatively poor, it's about a 3% delta in public equities. Back to the second, okay? But as you're thinking about venture capital and why you want a specialized intermediary, when you're dealing in an inefficient market, the variance between what is good and what is bad is massive. To put a direction on it, it's about a 20% swing in terms of returns between 25th percentile performers and 75th percentile performers in the world of venture capital. That's why I encourage you to think about VCs as sushi. The great are sublime. They will leave you happy and wanting to return again. The awful will have dire consequences that it's not going to end very well.
And I've been in firms that have been both.
Becca. Yes. All right, so going back to the notion of efficient versus inefficient markets is the question. One dimension of this is going to be how much information do we have about the companies or the assets in the market? If we really know a ton about, say, the assets, then the price and the valuation becomes more readily knowable. We say that's a more efficient market as opposed to a market in which we don't know a lot about the underlying assets or there's massive information gaps. We refer to that as inefficient. Another dimension is liquidity. So if you want to sell tomorrow, is there a ready market for it? That makes for a more efficient market as opposed to one in which there's less liquidity. Yeah.
Let me give you another example. You can go to buy a car by yourself at the dealership, right? It's efficient enough market. You can go on the internet, you can get an idea of what the car should be going for, and you go in and deal with the jerkwad with the tie, and you get a car. Sorry if you're a used car salesman.
So we've offended burrito salespeople as well as
I'm just
cars.
getting warmed up.
Yeah, okay.
So number two, the house. Some of us can go buy a house directly. Most of us can't because it's more inefficient. You have some idea. You've got some tools, Twill, whatever, Zillow and whatnot. You get an idea. Startups, average people out, if you're trying to invest in a startup, there's no information, right? The only information you're going to get is if you have a relationship with the CEO and what the CEO wants to tell you. And the CEO generally is I'm going to know better questions to ask the CEO than you who are not a professional investor. And there's reputational constraints. The CEO screws you over. They don't even know who you are. You're one person in Boulder. They screw me over. I've got a pretty good network in the startup world. Probably not a wise idea. Yeah.
Just, you guys may come back to this in a few minutes, but is this notion of efficient versus inefficient changing as crowdfunding?
We're definitely going to bring up crowdfunding a little bit later. So yeah, it is changing.
It's a great question.
And we will be there.
As I mentioned, Jason and I teach a course on venture capital. We've been doing it for 6 years. And one of the best parts is students are always keeping you on your toes. And so in between the sushi burrito model, a student this year gave us the edge case, which is the sushi burrito, which I still don't know quite what to do with that, but that's somewhere in between. All right, let's get into part 2. So that's broad context as to what problems the VC is solving as between a startup and limited partners and what function they're performing. Let's get into now the decision that I'm a startup. I'm interested in deciding whether to pursue venture capital, and if so, what I'm going to get into. Let's talk about the menu of options first in terms of finance. You're a startup early on. What's the menu you're looking at?
Well, one option is to fund it yourself, which we call bootstrapping. Just write checks from your bank account and own the whole thing and have a nice day. And there have been many successful companies that have done just that. Number two is you go to what we call angel investors. And angel investors are people who wear white and have wings and come down and write checks for you. They also look a lot like your mom and dad and cousins and friends, but that's purely coincidental. These folks can help you get money for your startup. They can not nag you all the time like a venture investor saying, hey, where's my monthly financials and where's this and that? They may not be able to help you as much. But also, I tend to find that people who take money from their friends, family, they have even more pressure than taking it from me, right? It's one thing to lose my money. You lose Aunt Gertie's money or mom and dad's after they've already put you through school, not so cool. So the next step up from angels are what we call micro VCs, which didn't exist a few years ago. And this is sort of an evolving situation in that you had a whole bunch of angel investors who were very successful and then started taking small amounts of money from others. And they're not full-fledged VCs, but they're sort of professional angels, micro VCs. And then you've got venture capital firms which can range from anywhere from $50 million to billions of dollars under management. And these are your options. Now, one thing to keep in mind is the incentives of these different groups is radically different, right? If you bootstrap your own company and it's making a nice cash flow, you're sitting back, you get a great job, you get a great company, you're making money, life is good. Angel investors may or may not need their money back in a long time. Your parents may be happy to give you money for 20 years, and if something happens, excellent. VCs, however, as I mentioned earlier, we actually sign agreements that say we're going to do everything in our power to get all your money back within 10 years, which means as soon as I give one of you money for a startup, that clock is ticking, ladies and gentlemen. I need my money back, yo, and it's got to be in that time period. Don't get any illusion. And by the way, you hear about VCs talk about, oh, we make great companies and we fund awesome, sustainable companies. You know what? That's great, and that's truly the goal. But at the end of the day, I have one job. I take money from my investors, and I have to give them more money back. If that means you're going to be a quick flip or I'm going to make money, you know what? As long as my investors get their money back, I still have a job, and that can play different to how your incentives run. Yes?
What kind of return do they expect over a 10-year period?
What kind of return do my investors expect in a 10-year period? 20 to 30% return, at least. That's by the way, that's yearly.
All right, let's tie that to the...
So, if I'm, by the way, 4 to 6 times their money back over 7 to 10 years is another way of looking at it, if you don't want to figure out the percentages.
Let's tie that to VC math and scalable ideas.
So first of all, the VC math, as far as you talk about the number of fails versus successes, I mentioned earlier, is if you hit 300 with some power, I do well. If I invest in 40 companies, 1 or 2 may be super big hits, maybe 10 do okay, maybe another 10 or 20 return the money and the rest are failures. But at least half the companies, at least, are not moving the needle for my return on my investors. So what I do, if you're coming to me and saying, Jason, I have this great idea about this app that'll allow college professors to order food to their offices so that we don't lose the productivity of Brad Bernthals of the world going out to lunch.
Big market.
Big market. I just made that up on the fly, by the way. I think it's a pretty good idea. Somebody should do that. But the issue is, man, that's not going to return hundreds of millions of dollars. I can only invest in things that are going to be huge home runs because I'm going to lose a lot of companies along the way. So when you're thinking about, is VC right for me, think about what you can ultimately grow this thing to. If you have an app that does something really awesome, but it's, you're going to make $5, $10, $20 million a year at best, that's a great business. Figure out some other way besides large VC to fund it.
Talk a little bit about market size that you're looking for.
Well, market size can be all over the map. I think the irony about market size is that if you have an innovative startup, by definition, nobody knows what the market size is. I love when entrepreneurs come in and they make a great valiant attempt to say, hey, I've invented a new X and the market is Y. And my answer is, how do you know? There's never been an X before. It may be lower, it may be higher. But one of the things that I'm going to have to agree on with you is what that market size is. And that's not, we can't just open up the newspaper and say, oh, the market size of this is Z.
What kind of companies do you see getting funded today?
So the companies I'm seeing getting funded today depends what sector you're in. So I mean, you've got software, biotech, medical, clean tech, all different, hardware, all sorts of different things. One thing that is pretty consistent right now is VCs are looking for very capital efficient businesses. Businesses that need 50, 100, 200 million dollars to succeed are hard to raise money. Now you may be thinking, wait a minute, Jason, I read TechCrunch every day, and every day I'm hearing about some company raising $100 million or $500 million on crazy valuations. What are you talking about? Those companies that are doing that, they've already hit escape velocity, right? Those ones have already proven to be such monsters that anybody can raise money, but when you're starting off, try to be extremely capital efficient. And the good news is you should be able to. When I started in this business, oh my God, 17 years ago? Ah, Jesus, I'm getting old. You had to raise $5 million just to launch a website. Now, all of you are snickering because anybody here can go launch a website for 20 bucks now. So things have radically changed, and what's been good about it is that you don't have to raise as much money and lose as much of your company to get a product out.
How about?
Yep.
Can I ask a clarification on that?
Is that Elizabeth? I can't see.
It is.
Oh, hi there.
So, you said that most of the startups that you see, they can't really quantify their market.
Yep.
But, we get a lot of deals that there's clearly a market that's too small, even if they expand. So could you talk a little bit about how you view the potential of the market and how small is too small?
Yeah, so to your point is sometimes we see something that the market's too small, and the question is, do I believe the market's going to get bigger or not? So one of the things that we do at Founder Group to try to figure this out is we don't invest in sectors. A lot of venture capitalists invest, we invest in storage, or we invest in clean tech, or we try to take a horizontal look at the world. So we'll invest in a theme called human-computer interaction, which is anything that's next generation ways of us interacting with computers. And what I believe is that when you look at the world horizontally, you get a better intuitive sense of how big that market's going to get. So I think it's really helpful. Most of the times when I see a market that's too small, unless I am sure that I believe in a bigger market because of some other investment I have, I usually am too scared to invest because that's a huge, big issue. Now, one of the things is if you come in and say, hey, we're not sure the market's that big, but we're only raising a couple $1 million, it might be worth me to take a chance with a small amount of money like that to see if the market's going to be big and help as a board of director guide you. If the market doesn't look that big, let's not spend too much money. And maybe you raise $2 million and sell it for 10. You guys, you would make a lot of money in that deal, and I wouldn't get rich for my investors, but they certainly wouldn't be upset. So you do take some flyers along the way as well.
Let's talk about one dimension that we've already alluded to, and that is.
But not the band. That's One Direction. Right? That's totally different.
Well, I was going to sing a little bit, which
I'll give you $5 if you sing right now. I've never heard you sing in public.
Is that open for the next 30 minutes?
No.
It's got to be now.
Yeah. And you're wasting time. We don't have much time.
When I was a little bitty boy,
Wow.
my grandmother gave me a cute little toy. Does anyone recognize the song?
That's awesome.
3 silver bells.
Hey! You owe me $15, by the way. I don't have change. Nice job.
We got to do this more often. That's pretty good.
By the way, but you owe me $15 now. Just keep that in mind. You're all witnesses.
No one could tell. That was Chuck Berry, by the way. The shot clock idea that a VC has to return its fund to a limited partner. Let's talk a little bit more about that. So one interesting element that I don't think we've mentioned this, the standard fund time length, actually you did say this, is 10 years with a couple 1-year extensions. Okay? There is actually one fund in town, Infield Capital, that specializes in clean energy investments. They're actually structured as a 15-year fund, and that leads to the next question. That's because the time horizon to an exit event in clean energy, they anticipate would be longer than in other sectors. Talk about, in your world of software, time horizons to exit and how that's changed over really the last decade in terms of what you expect.
So the bad news is it's not my choice to make it a 10-year fund. The bad news is there's all these regulations which are way out of scope of this discussion, which force many of my investors to not be able to invest in anything longer than 10 years. Now there's wiggle room. I get 2 one-year options, so I can make it 12 years. But at the end of 12 years, my limited partners can come shut me down and say, bye. If I own shares of your stock, I then go and sell it to Guido, insulting people named Guido in the audience, who works in New Jersey, insulting people from New Jersey in this room, who basically will pay a couple cents on the dollar and who you don't want to own the securities of your company. One of the things to be extremely concerned about is if you are an early stage startup is, Jason, when is the last time you raised money? Most entrepreneurs don't ask that very simple question. You want to ask your venture capitalist, when was the last time you raised money? What year are you in your fund? If the answer is, I raised money 5 years ago, when do I have to see an exit with your company? 7 years at the max. Now, 7 years ago in 1999 was like forever, right? We used to like buy and flip stuff in 24 months in 1999, but we're no longer partying like it's 1999, and things take a lot longer. On average, 7 to 9 years now. So be very careful about getting in bed with a VC who doesn't have a new fund.
Well, so I know for Founder Group, you guys have 4 different funds that you raise.
Yes.
So does that start the clock each time that you raise a new fund, even though that that's allocated for example, your last fund is for later stage companies?
So I have 4 funds at Foundry, which is the point. The question is, does the clock start again every time I raise a new fund? The answer is sort of. So I raised a fund in 2007, and then I raised a fund in 2010. Now, when I raised that fund in 2010, do I begin investing immediately? Well, no, but I want to overlap my funds, right? If I raise 2007 and then run out of money and then sit around for 6 months raising new money and you all come talk to me and say, hey, I'd like to raise money from you, and you know I don't have money to fund you, that hurts my reputation. So we had an overlap, and we were doing new investments out of 2007 while we had the new 2010 fund. We were making sure and being very open with the entrepreneurs, hey, look, you know, we're going to do a little later stage stuff. We're probably not going to do the 2 folks and a dog and a PowerPoint slide sort of stage company. It'd be a little later. You laugh. We've done 2 folks, a dog, and a PowerPoint slide. It's been really good. It was called GNIP, and it's working out very well. And then same with the 2010 fund and the 2013 fund. So effectively it restarts. Like right now, we're only investing out of the 2013 fund. So if you're good at math, you'll know that I have 9 years left. Right. Okay.
One last piece on the fund. All of your funds have been $250 million. Correct?
225.
225. 4 partners.
Correct.
Okay. In terms of getting that to work, does it work out essentially 225 divided by 4 and what each of you are roughly investing?
No.
How's it work out?
We don't keep that stat.
Okay.
My guess would be that 2 of us, and one of us whose name rhymes with Mason Mendelson, probably spends on the high end. Just saying. But we all have the same amount of deals. Okay. It's about 25 to 28 companies per fund.
All right, so we've talked about some of the factors that might drive you to consider whether VC is the right financing option as opposed to other alternatives that are out there. Now let's talk about how do you know if you're talking to the right VCs, some initial consideration from the perspective of a startup.
So first of all, Crunchbase, if you're raising money, Crunchbase is your best friend. Find out the VCs, what they're funding, when they raise their last capital. Are they investing in companies that are similar to what you're doing enough that they'll understand but not competitive? Don't come to me with a biotech deal. Don't come to me with something from India. Not that I have anything against India. We don't do foreign deals. Not insulting India. Insulting Guido in New Jersey. That's still on the record.
You wouldn't do a deal from Asia, so we can insult the entire continent, right?
Awesome.
Yeah.
Perfect. Don't come to me with something that's late stage. Like if you've already raised a whole bunch of money, I'm not the right person either. The first thing is do a little research, figure out if we invest even in your type of company. Second, do some research on the individual partner that you want to talk to at the firm. Find out, what they are. Like for instance, there's somebody in the back row wearing a Michigan shirt that says Michigan Friend. If she were raising money, she might be smart to look on the website and realize I went to the University of Michigan and send me an email. Be very, very strategic about that. One of the things I like to say is I'm constantly amazed at how strategic entrepreneurs are in their own businesses and how lazy they are when it comes to fundraising. They're so tired, and fundraising sucks so much. And by the way, I know I got to raise money from my investors too, okay? The first Foundry fund took us 19 months to raise. It sucked. We were writing checks into the company every month just so we could afford airfare. I know what it's like. But be very strategic on both your company and your fundraising.
What if I see that you are right in the sector of investment that my company is playing in, but I see a potential competitor there?
A competitor that I've funded?
Yep.
I don't think you should talk to me.
Okay. How about in terms of, you mentioned, look at the individual partner that you're speaking with at the fund. Talk about the different roles of people within a fund and what that might signal to a startup entrepreneur.
So there's a role called managing director or general partner, which is generally the top row. If you're talking to a managing director or a general partner, you're usually talking with a decision maker who can get a deal done. Anything other than that, it's questionable. And as you move farther down the stack, it becomes more questionable. There are many firms that have teams of associates whose whole job it is to call people with outbound calls, much like salespeople, and look for companies. That can be good or that can be bad. It can also waste a lot of entrepreneur time. So make sure that if you're speaking to a venture capitalist, at least on the second meeting, you should be talking to partner level folks. Because if you're not, then you're not talking to people who can make a decision.
Stage focus in terms of funds, stage of a fund.
So many firms, VC firms, focus on stage of investment. So we focus on seed and early stage. We say nothing is too early, but if you've generally raised more than $3 or $4 million, you're not for us. That's us. There are firms that invest in all stages. There is a lot of literature and scholarship being done on what is a more successful model, and it's looking like stage specific firms do better than ones that invest in all different ranges. It's still sort of a TBD. We'll see how that works out, but make sure you're going after the right stage as well.
Let's elaborate on that just quickly. So you mentioned seed stage, very early stages of the company. Talk about emerging company, growth stage, and later stage.
So we've thrown around some words, these words things, that we should probably, that was for you, by the way, that we should probably define. Seed stage is the earliest as it goes. Seed stage is, oh my God, I'm naked in the shower. I've got a great idea. I'm going to start this company. That's as early as you get in a company, which unfortunately is most of my good ideas come there, and then I forget them because it takes me too long to wash my hair and get out and write it down. As you move along, you have what are called early stage companies, which generally are the first round that they've raised, which is as sometimes called a seed round. The first larger round is called a Series A round. And then there's no big magic. There's a Series B round and C. It's just the Roman alphabet. Your question is, well, Jason, how late have you seen? I have seen Series Gs before, which stands for GOAT. And if any of you are invited to invest in a Series G, you should probably respectfully decline. But as the companies start raising different rounds, A and B is generally regarded as early stage, and C's are middle, and D and E's are late stage. And there's no rule. It's more or less just kind of a general lexicon that we use in the industry.
All right, let's talk about from the perspective of the venture capitalist.
This scares me because I don't dance.
Well, I just sang.
I'm not dancing.
I'll sing while you dance.
I'm not dancing.
So, but I think it's helpful for entrepreneurs to have some sense as to what does it look like from your perspective in terms of the funnel. So how many inquiries do you get? Let's start there, and then how do you whittle it down? How many make it to the second cut? What's it look like in terms of the funnel?
So the blue part of the funnel we used to count, and it used to be between 4 of us. We would get somewhere between 5 and 8, 9, 10,000 inquiries a year. We don't count anymore because it just takes me too long to count. But it's only gone up. The red part is sort of what would generally be somewhere in the world of things we would invest in, because that 10,000 includes, hello, I'm in jail and I want to start a tanning salon when I get out of jail. Will you please fund it? Don't laugh. We just got one of those the other day. Inmate number, it had been reviewed by the warden. I'm just like, how the fuck did he get my address? Pardon my French. So,
keeping track, we've now offended entire prison populations as well.
Right. And sir, if you're watching this on YouTube, I'm just kidding. I hope you get out soon. Please call me. So there's that. The red section is things that we actually might invest in, which is probably in the neighborhood these days of about 1,000 things a year. The yellow are things that we engage in. which are going to be somewhere in the neighborhood of 300 to 500 a year, which means either some sort of email or a call or a meeting or whatnot. And then you get down to this, which in our case is about 10 a year. So there's the funnel.
All right, so how's that cash out in terms of communications? I'm trying to get your attention. Talk about email, phone, other communication do's, don'ts.
I hate them all. I hate the phone. I don't like email. Don't really have a choice. What it means is you don't carpet bomb emails. I would say about 80% of the emails I get from entrepreneurs is they craft one letter, buy a mailing list, do a mail merge, send it to me. It's really obvious. Delete, archive, right? Don't answer it. What it means is it's really simple. I always tell people, connect with me on something I'm interested in. For me, that's, I grew up in Detroit. I'm somewhat proud of that in a weird way. I went to University of Michigan. I teach here. I like music. I love food. I've lived in San Francisco. I'm not the most interesting guy in the world, but there's a lot of things I find interesting. Find something. I like football. I like teaching. I like education. Find something just so I know you've at least spent 2 minutes doing diligence. Because remember, if I'm going to invest in you, I want you to be hungry and hustle and on top of everything. And if you're not that way toward me, you've lost already in the first email.
Early communication.
And please don't call me. Just email
Executive
me.
summary versus business plan.
Who here has an MBA? Okay, I'm sorry, but everything they taught you about writing business plans is wrong. We don't like business plans. You think with a funnel like this, I can read your 75-page crappy business plan with risk factors and financials that you've guessed on because you can't predict the future, and if you could, you should be a stockbroker? Not interesting. Short, concise. Again, I'm judging you not just by the business plan, but the way you communicate toward me in that business plan is how you're going to communicate to the people you're trying to hire, the customers you're trying to sell, the VCs you're trying to get funding later. Damn it, be concise, be crisp. Get me excited. I want to fall in love. I always say that people say, well, how do you know if a deal is, how do you get trained to be a venture capitalist? There's no school. And I said, have you ever dated? And most people who are engineers say no. But the other people who aren't engineers, I kid. The people who aren't engineers say, yes, I've gone on a date. And I say, well, it's a lot like dating. You want to fall in love. You want to meet a compelling human being. You can't wait for the next interaction, and you're just super stoked. That's the type of communication I want. I want you to feel the same way. I want to be excited. And so that, I prefer executive summaries, which are 2 to 5 pages, or a presentation, especially if you're doing a consumer application. Show me your great design chops in that presentation. I'm like, wow, this person really knows how to make beautiful software. Consumers are going to love it. But I want to fall absolutely in love. I also call it the beer test. If I don't want to go have a beer with you, then I'm not going to do business with you because we're eventually going to have some hard times and going to have that tough conversation over beer. And if we can't do it in the beginning, we're not going to be able to do it later.
Solo entrepreneurs versus team.
Solo entrepreneur versus team. I don't ever want to invest in a solo entrepreneur. It's too bad. There are some awesomely solo entrepreneurs. Speak grammar much. There are some great solo entrepreneurs everywhere you go. The problem is if you get hit by a bus, I've got nothing as an investor. And 2, if you can't find a business partner, then that might say something about you. That might say that you're not able to inspire people to join your firm. That might mean there's some tick with you that you don't play well with others. That's going to be really hard as this company tries to scale.
Rookie mistakes to avoid. Let's cover NDA as well as hiring non-technical talent and how that's a flag for you.
And NDA stands for non-disclosure agreement, which lawyers will tell you are very important. If you're going to give a secret away, you should have a non-disclosure agreement so that I promise I'm not going to give your secrets away. Sounds completely reasonable to send to a venture capitalist. Why is it not reasonable? I do care. I really do care. Do I not?
You wouldn't sign it because you might have somebody in your portfolio company that's already either in that realm.
Or I'm looking at the 10,000 deals I get and there's 17 like things. I just can't. It's just too hard to keep track. As I wrote in my VC code of conduct, I will never sign an NDA, but I'll reasonably try my darndest to comply as if one's in place. By the way, if I don't act that way, what happens? She goes around and tells everybody he doesn't care, and then my reputation suffers, and I'm just teasing you. But I really care about my reputation, despite me being here tonight and acting like a jackass. I honestly care about my reputation. So don't make rookie mistakes like ask people for NDAs. You can go on the internet and look for NDA VC, and there'll be 50 articles about why this can't happen. So I know if somebody asked me that on the onset, they've done no research about how this game is played.
Early hires and your view of especially overinvesting in marketing and other expenses.
So the other thing we're going to pay attention to as venture capitalists is who you've hired early. If you're a technical co-founder, if you're a technical founder and your first hire is a CFO, Chief Financial Officer, I'm going to say, you haven't sold anything yet. You don't have any money. Like maybe that wouldn't be a great hire. Be very careful. Those first 2 or 3 hires not only signal to people like me in the market what your plan is and if you have experience, but also set the culture, the DNA, and everything of your firm. Consequently, don't hang on to an early hire too long. I always like to say, I don't like to say it, but it's true that you never fire somebody too early. You're all snickering. Does that sound, and somebody take me on and tell me why that makes me sound like a jackass VC. Because then I'll turn around to you and say, who here has ever been in a relationship that they didn't fire their significant other fast enough? Everybody in this room has somebody in their history.
My wife's making eyes at me.
I actually have something to talk to you about later. But we've all been there in our personal lives. We've all been in relationships where we knew we should have gotten out 6 months earlier. It's no different in business than it is personal. And so the early team, you've got to hire awesome. You've got to be very selective, and you've got to cut immediately when something's going wrong. There's actually a company in here that I won't embarrass, but there's two of them that I think have done a fabulous job of hiring just unbelievable first early hires as far as the culture. And it made me feel really confident that the co-founders really could do a good job with the company in whole because of the quality of talent they were able to attract.
Fundraising conversations too early, so premature. And also, if you're a startup and you don't want to embarrass yourself in a fundraising conversation, where do you go to practice?
So I believe that every entrepreneur should go through their fundraising pitch at least 20 times before you give it under real fire. 20 times will, and by the way, 20 times seriously, not 20 times just I'm going to do it. What you'll find is most people have verbal tics. First of all, the presentation may suck, right? You got to go out there and you got to get the fine tune it, talk to your friends, talk to advisors. One of the greatest things you do is talk to a venture capitalist who no way in hell would invest in your company, so there's no weird incentives. Somebody you trust, somebody you like. But then go do it 20 times and get rid of all those verbal tics you have, the ums, ahs, ohs. I watched a presentation today that was painful because at the end of every sentence is, we did this, and that was cool, and then we did this, and that was interesting, and then we did, and everything they told me, they then had to tell me it was cool, interesting, neat, or unique, and it was just these throwaway lines, and it was them just stalling for time as they were trying to figure out what their next line was. They just hadn't practiced it enough. I would tell you it's never too early to go to a trusted source and get advice about fundraising. If you don't know the venture capitalist, you don't have at least one degree of tissue that binds you, I would go later. I wouldn't go earlier. But if you can talk to people who are either professional angels or people like Brad, who is in the business, or VCs, go early. Get that feedback early and then iterate.
What's your interest in a polished presentation as an investor?
I don't care about polish. So the question was, what's my interest in a polished presentation? I'm not sure polish is the right word. I want this emotional attachment. I want you to come in and be enthusiastic, know your stuff cool, just cold. I want to be inspired by you. I want to feel like, oh my God, I'm going to learn a ton from this guy. I can't see your name. Norwood? Like, man, this Norwood guy knows everything about this. Wow, I'm going to learn a ton. It's going to be great working with him. And if you're comfortable and you know it and you're just talking and it's a conversation, then it's exciting. If it's Brad and I standing up here and going, and on page 26, you can see this funnel, which is in 4 colors. And that first one, I think it's blue and red. You're already bored. So it's not polish, it's that crispness. I mean, I'm not going to lie to you. We've not done this presentation 20 times. We've been teaching the class for 6 years. You know, we can do it at this point.
One of the most fun parts of our class, we've had some courageous entrepreneurs over the year that have come and done a simulation first coffee in front of the full class. And a couple things that have emerged out of that. One is there's no beating dynamism, right? So if you've got a deck, don't do a death march 1 through 20 in the deck. If the VC wants to go to slide 15, go talk about slide 15, and then you know the rest of the deck. You can go back to it and cover that. That's one piece that's emerged. Second is you should know your expenses. In terms of revenues, this is wild guessing in the market, and Jason understands that. But if you can't say how the funds are going to be used and what you expect the burn rate to be, that's something that gets a little irritating. And one of the most interesting is when you have multiple founders in on a pitch, that is a strong signal as the team dynamics. If they're stepping on each other, if they're interrupting each other, if they're contradicting each other, this could be a red flag. And in fact, there was a company that came in about 5 years ago, really interesting company. And as I said, courageous to come in front, but it was clear that the team dynamics were a little odd. I thought Jason was being unfair the next day when he said, well, that's just never going to work. And sure enough, a year later, they came back and said, yeah, we didn't get along so well. And that was it. I was, wow, it was pretty good. By
the way, the favorite part about class is punking you on a regular basis. It's not that, but that's another story.
This is worth a 2-minute digression.
No, we got to go. We got to go.
All right, we can come back to
We'll
that.
tell it later.
All right, we're about ready to make the final turn. Any other questions about the pitch process? Yeah.
You mentioned earlier that you're not interested in a startup that's already raised $2 to $3 million.
Yes.
Explain why that is.
Yeah, it's just me. It's nothing against you. And there's plenty of venture firms that do that. There's two answers. There's a couple of answers. One, we feel that we're special at evaluating early stage deals and less special once it becomes more of an execution play. You know, they've raised some money, they've got a product out, they've proven the market, and now it's about scaling. I mean, we're good at it, but it's less interesting to us, and we don't actually feel that we're that differentiated from a whole bunch of other people. We really feel we can help really early stage stuff better. So that's one. Two, the way our economic model works, which is, I'm not happy to share, but it's kind of out of the scope for the night, of how we figured out, well, if we do X investments of these valuations and how we'll present returns to our investors, it doesn't work if they've raised a lot of money because the valuations become a lot higher, right? We get much lower valuations and I can own much more of the company for much less money at the earlier stage. So part of it's economics. And for me, three, just personal interest. I like early stage stuff. I like stuff that's messy. You know, I like stuff that every morning is, okay, now what? It's stressful, but it's cool.
Can you say the biggest miss over the years because of that strategy that if you look back, like, oh, I wish I would have done it anyway?
Ooh, I don't know. I have so many. Do you have one in mind? Why don't you tell it? I've screwed up so much. You're asking me for basically the one time I screwed up?
No, just one.
This one time at band camp? What?
Should your pitching duration be like 2 hours or 3 hours?
You're serious?
No, I'm being facetious.
Okay. I think a pitch should be 15 to 20 minutes. And you know how you know you nailed it? Is when I'm there 45 minutes to an hour because it's become a discussion. Because as soon as it goes from pitch to discussion, you won. You're now controlling the floor. You have my interest. And so when do we get to meet next?
And you've got a line, the goal of the first coffee is always?
To get a second coffee and have me pay for it. I pay for the first one too. Nobody takes out VCs for lunch. That's like another rule, but it's not in the pitch deck.
All right. Let's do the final part of this in about 10 minutes, and then we'll leave 20 minutes or so for general Q&A.
Why no?
Mechanics. So
We don't invest in mechanics.
What's that?
We don't invest in mechanics.
Well, you haven't heard my idea yet. It's going to be beautiful. All
right, let me rephrase that. I won't invest in you. Sole founder. There's no way you're going to get somebody to go with you.
I brought my teammate already. Oh, she just left, though. Yeah, that line about never fire him too early put her over the top.
Yeah.
All right, so let's start with, we've now moved from, here's the big picture of VC, here's some considerations about, is your company appropriate to get into VC, and what are some of the do's and don'ts during the dance? Now let's say that we're getting close. Jason's at the point where he said, yeah, here's a term sheet. Let's start with the discussion of a term sheet itself and what that is in terms of enforceability especially.
So your goal after many meetings is to get a term sheet from me. And a term sheet is a summary of terms that will define our marriage, which we'll eventually commit to paper by lawyers who will charge us too much money but look really good in suits and be happy. I kid. Some of you are out there, some of you I like. And this summary
We're in the
is
law school. Those lawyers are worth every penny.
right. Anyway, the idea is to get this term sheet, which is we sign, you sign, I sign. Now, the term sheet is not binding, okay? So one of the things to keep in mind, and this is a dirty little secret of the VC world that isn't spoken about, so we might as well talk about it and put it on YouTube, is that many venture firms put out term sheets and sign them having not finished their investment due diligence and don't even have approval within their own partnership to do the deal. So what happens is they give you a term sheet, you call all your other girlfriends / boyfriends and break up with them, because remember, this is not a monogamous sport, and then I don't close and you're left standing at the altar. Not cool. Make sure, if you get a term sheet, that you ask, hey, when you give a term sheet, what does that mean? In the case of Founder Group, that means we're done, we're committed. That means the only thing left is we're going to give the paper to the lawyers. Now, the lawyers are going to do their legal diligence. We don't do legal diligence. Despite my background as a lawyer, I have zero interest in that. I'm not good at it. But I'll hire a firm. In fact, one of our lawyers is sitting over there. She does a wonderful job of going through and figuring out all the legal stuff. But from a business end, I'm committed. I've told her, go close. If you don't find anything, close this thing. And so make sure that you know what a term sheet means.
Let's talk about the structure of the investment. And this is between the venture capital fund and the portfolio company itself, and why you're going to use preferred stock. And let's just mention maybe one or two of the bells and whistles that'll come with that.
So there's two types of stock. There's common stock, which is aptly named common stock because it's common. And there's preferred stock, which has some terms which makes it preferred over common stock. One of the big terms I'm going to get is, by the way, if I put $5 million into your company and you sell it for $5 million, I'm getting my money first. I get my money back first before you get anything. And that's very standard. But keep in mind, the more money you raise, the more money needs to be returned to investors before you see anything.
Liquidation preference.
It's called a liquidation preference, which mine is Vitamin Water Zero tonight.
I don't know why I like that joke. I shouldn't encourage it. All right, one other element of preferred stock that I want to highlight is protective provisions, because I think a misnomer is that an investor has to own either majority stake of the company or control the board of directors in order to have control. That's not the case. Protective provisions are a powerful mechanism for an investor to make sure that certain opportunistic behavior is not going to occur.
Correct. There's a paragraph in all deals that say you shall not do the following things without getting my permission, irregardless of how much of your company I own. You can't sell the company. You can't raise more money. You can't license intellectual property, blah, blah, blah. There's a whole bunch of stuff. But it doesn't matter if I own 1% of your company or 80% of the company. I can stop you from doing a lot of things. Just keep in mind, make sure, oh, by the way, if you're going to go the VC route, please, dear God, hire a good lawyer. Not your cousin Vinny, right? No two Utes. Hire a good lawyer.
One final key piece.
Yeah, sorry, you had a hand up. Yep.
On the stock side, how do you guys deal with the passive stock, or have you dealt with that? Does that normally negotiate out?
If you're talking about founder stock? Yeah, there was a blip. It's really not around anymore. There used to be a thing called Class F stock, which founders were like, you know what, the market's crazy, VCs love me, I'm going to negotiate a better deal for the founders and have a special class of stock. That went up, and it's pretty much gone.
Okay. So if a company was founded with that, you guys just normally negotiate that now?
It depends. It depends how egregious it is.
Okay.
But I don't like the idea of me putting in money, and if it's a crappy outcome, that you get part of my money again after you've lost my money,
Okay.
which is effectively what that says. Doesn't feel right to me.
So, yeah.
Can you talk about whether this changes if you've got multiple VCs in the deal and how it changes?
Yes, so the best thing you can do to negotiate a good deal with me is find somebody else that you want to date. It's the homecoming thing, right? You know, there's the girl whose locker was next to you, and you knew that guy Stan down the hall, he was going to ask her too, so it sort of forced your behavior. You had to up your limo and get something a little nicer. Didn't work for me. I still got no, but I ended up paying for a more expensive limo. The idea is get multiple venture capitalists involved. They're never going to relent on preferred stock. They're never going to relent on the protective provisions. This stuff's standard. Again, plugging our book, Venture Deals, Be Smarter Than Your Lawyer, we will go through in excruciating detail all of these terms. But the big one, valuation, which determines how much of the company I'm going to own at the end of the day, That's completely fair game when you get multiple VCs at the table.
Okay, final note, by the way, Jess is gamely trying to reach people. If you
sorry.
get there, great. If not, we'll repeat the question. In terms of preferred stock, before we leave this topic, important takeaway is the holder of the preferred stock has a right of conversion, which means that Jason will hold preferred stock until he elects not to, and then he can convert over into common stock. Just know that that means that he can keep his bells and whistles when it's to his advantage to do so, but if he wants to come in alongside the common stock, he's got that right to do that as well, okay? Control and return. So getting to the point in which you're going to negotiate a term sheet, what matters versus what doesn't matter. Talk about how you, as a VC, as a portfolio company, would read this in terms of control and return.
Well, I'll actually turn to the gentleman in the, I think, green shirt, who, my eyesight's going badly, so you may be my brother and I can't even see you from here, but if you have multiple VCs in a deal, and you're trying to judge which deal is better than not, very easy framework. The only thing VCs should care about is control and return. In other words, does this thing I'm asking you for give me some control of your company? Or does it juice my return and give me a better outcome at the end of the day? If it doesn't do one of those two things, then your VC might be a micromanaging jackass and who is going to look at the wrong things and be trying to optimize things that they should not. So even a non-lawyer can say, wait a minute, how does this affect either the way that they're going to help control against bad behavior or get more money? If it doesn't fall into those, then that's a problem.
Give us one provision that you think generally doesn't matter.
I think registration rights, which lawyers love to argue, it's if a company goes public and I have shares and I can register my shares, and I mean, I need them, but don't really care, and I'm not going to argue about them.
All right, 3 maxims that we teach in our course. First, multi-stage games affect behavior. Okay? This relates to the power of reputation, among other things. Note that in some deals, reputation is going to be an important constraint and incentive. So for example, if Jason is mid-career as a venture capitalist and I expect him to want to be a repeat player in the world of early stage capital over another 20 years, his behavior, if it's observable, affects his reputation, and that's going to drive a certain set of behaviors, right? Same thing with startups. Talk a little bit more about the role of reputation from your vantage point.
I mean, think about it. If we're negotiating a term sheet and you hire one of O.J. Simpson's ex-lawyers who just pounds me in a submission, and then we're supposed to join up and sit on the boards together and work together, you've done a poor job at realizing this is a multi-stage game. If I decide to sue Brad tomorrow for libel and slander because of all the horrible things he said about me tonight, that's a one-shot game. It's a winner-take-all thing. I'm going to bury him. So make sure. Hi, buddy.
Right, that's all right. Now I'm in with Asia, criminals, and other groups that have been offended.
Right. Yeah. So keep in mind whether you're playing a multi-stage thing for customers. Is this, are you going to be interacting with this person a lot? But in M&A, if some company's buying you, this is a one-shot game. It's winner-take-all, and then everybody goes home with their marbles at the end.
Interesting questions. We talk about crowdfunding, how that's going to affect whether people view an investment as a one-stage game or a multi-stage game, and that has some really interesting questions.
Yeah, and the answer is it probably is more of a one-stage game, right? A person can go on an angel list and for $1,000 sign up and invest in a company, and who knows what reputational constraint. It's not like having $225 million under management for each fund and a whole bunch of. By the way, my reputation not only flows to the startups, but it also flows up to the investors. Angel investors may not have that same sort of reputational constraint.
Maxim number 2, investors love precedent.
So keep in mind, anything you promise me as your early stage investor, Bernthal Ventures, when they come to lead this Series B, is going to take everything that I got, and because they have to and they can't help themselves, ask for more. So precedent is very important in this industry.
Talk about how that makes an early stage investor like you more closely situated to founders as you have later stage rounds in the company.
Yeah, if you have an early stage investor who's really trying to take you to the woodshed and win a lot, that is probably a person who's not very experienced, because what's going to happen is if I take you to the woodshed, he's going to come and take the company to the woodshed. And by the way, the company at that point is me and you, right? Stage one, you're the company, I'm the VC. I take you to the woodshed, I win. Ha, suckers. But then he comes to do the Series B deal. We're in the same seat. We're in the same company. If he totally takes the company out, it affects me just as well. So be very careful of that. A good early stage VC will not ask for draconian terms.
So let me give you an example. We talked about the liquidation preference, which is the amount that the VC gets in, it's going to take out first. Let's say that Jason comes in with a $1 million investment, but gets something that's not a very standard market term right now, say a 3x liquidation preference. That is, he's going to take $3 million out before I see anything. Okay? That might sound good after the first round, but when I come in for the B round with a $10 million investment and a 3x liquidation preference, because I love precedent, that means the company's got to exit for $30 million or more before anyone else is going to see a dime, before Jason or the founders. Okay? So that's a good example that you want to be careful, especially if you anticipate future investment rounds.
Good. Let's do the last one, and I want to talk about crowdfunding.
Today's agreement or today's contract sets the terms for tomorrow's negotiation.
So we just said that a good early stage investor wouldn't take draconian terms from you. What if it happens? What if Norwood only has one choice, and it's the founder group, and the founder group has been hit by a train, and their personalities have changed a lot, and we're now jerks, and we completely take you to the woodshed? Well, your company does okay despite it. We bought 80% of your company. You go to Bernthal Ventures. Bernthal says, I'll fund you, but I'm going to completely, I don't care about founder group. I only care about you, right? He wants you to be happy. So you guys then basically collude legally and say, and he says, I'm only going to do a term sheet in your company if Foundry goes back to standard terms. Same thing with M&A. Let's say you've had a whole career of not doing a great job negotiating these documents, and Google decides to buy your company. Does Google care about any of the venture capitalists? No. They care about you. You're going to come on board and be an employee of Google. So you can whisper in their ear if there are things that are unfair, and Google may be willing to say, yeah, Jason, we're going to buy your company, but you got to change X, Y, and Z. Now, I'm not saying don't respect your contracts. That's bad, and reputation does matter. But don't overly fear that there's no out if something bad happens. There's always steps along the way that you're going to have times to renegotiate things.
Let's do one more, and then we'll get into Q&A.
Yep.
A couple things that I like this list that it's either counterintuitive or VCs are not necessarily explicit about. First of all is the black magic around valuation and some of the ways that VCs will back into that.
So people want to know how we value things. It's not discounted cash flows, sorry MBAs. It's not spreadsheets, sorry MBAs. It's really, what do I think I can get the deal for? How much money am I putting in? How much of the company do I want to own? And I don't want to own too much that you're disincentivized to do a great job. Generally, I want to own somewhere between 25 and 30% of the company when it's all in. So if you're asking me for some money, I'm going to look at other deals that have been done in the market because VCs love precedent. I'm going to look at other deals I've done in my own portfolio. But if you think we're working with spreadsheets, that's wrong. It is a lot more this than you might imagine.
Amount of investment and
Amount,
how much
very fungible as well. I mean, obviously, you should have a great idea of what you want to raise depending on how much your expenses are going to be over the next 12 to 18 months. And by the way, you really should always raise enough money to either last 12 to 18 months or hit a major milestone, because you're either running the company or raising money. You're not doing both. And so the amount should be that amount. And by the way, if you don't like my valuation, if the valuation's too low, maybe you can say, okay, why don't you give us, if you need to own 25%, Jason, why don't you give us an extra $1 million and raise the valuation, and we're both happy. This amount by no means is a set in stone number.
We've talked about in terms of expertise, among other sources, book is a good one in terms of entrepreneurs coming into negotiation. They can get themselves up to speed. Talk about the ownership impulse, and you have an idea roughly what percentage of the company you want to own after the first round.
Yeah, like I said, terminal, at the end of when the company is exited, I'd love to own somewhere between 25 and 30%. And that might mean I'm putting in 15 to 25 million into the company for that. So that's a lot of money. If you're raising less money, I own less of the company. But remember, I only have two bandwidth constraints, time and money. I can only be on so many boards. So I'm not going to be on a board I only own 8% of the company of. It just doesn't make sense for my time. I need to own a substantial part of the company. Otherwise, I should look for something else to do.
and trusted introductions and the importance.
Yeah, and the last thing is there's nothing better to an intro to a VC from a trusted resource. So if Brad says, hey, I have this great student in class, you should talk to them. I'll meet with them or look at them very seriously. I don't want to see intros from other VCs. That's bad. If a VC is not investing in you, I don't want to do the stuff that they're not investing in. That's a bad negative signal, even if the VCs don't necessarily invest in the same things. But if you know a friend of mine or something, or you know an ex-CEO that we used to work with, those warm intros are worth a ton.
Let's open it up. Questions?
Well, let's talk about crowdfunding really quickly.
Okay.
So the first question was, how's crowdfunding changing all of this? The answer is no clue. It's too early. But that's not a real good answer. Jason, you've made a lot of guesses and opinions tonight. Give me an opinion. I don't think it's going to change much of anything. I think if you look at VCs adding money and expertise, the crowdfunding really doesn't, it's the mob. And maybe there's some people who are going to be helpful to the company, but maybe not. At Foundry, we've decided we're going to play both sides of the fence. We've actually created an AngelList syndicate called FG Angels, which if you feel like investing alongside with us, come aboard. We're actually crowdfunding companies through this program. But so far, it's too early, and there's still way too much stuff going on at the SEC, which makes it really hard.
Hey, Jason. Just curious on structure of corporation.
Yep.
LLC, CS.
I can only invest in C corps because if all the other structures, they have pass-through tax, which rolls to me, and guess who else it rolls to? My investors who are nonprofits or other people who don't want to deal with your tax problems. Has to be a C corp.
I was hoping.
Can I just make an additional comment on that? However, from the Entrepreneurial Law Clinic perspective, companies that see themselves eventually in Delaware as a C Corp often think that VC funding is going to come earlier than it actually does.
Yeah.
And there's nothing wrong with organizing, say, as an LLC here in Colorado, keeping your costs down early. And then if Jason comes along and wants to make an investment in your company, it's not that hard to move to another jurisdiction and change form. So just it's a key piece for entrepreneurs. No, you're not locked into the state. You're not locked into the same form.
Good point.
Yeah. Elizabeth.
So my question is, I'm curious whether Foundry, not FG Angels, but Foundry invests in convertible debt deals. And then my second thing that I was just hoping maybe you could clarify, since we have a good audience here, we've seen a lot of angels asking for 3x liquidation preferences. Which
It is all I can do to not say F them.
Yeah. So could you say
I'm not
what
sure that
is
you
the market
stopped
rate?
yourself.
and
No,
what
but if
would
this
be
were class, if
appropriate?
we're on YouTube, I'd actually use the real word. How about frack them for those Battlestar Galactica fans out there?
So could you maybe tell the audience what would be an appropriate liquidation preference for angels to ask for?
Yeah, 1x.
Okay.
Angel investors should ask for their money back, and they should look a lot like founders and common people. Otherwise, I wouldn't do business with them.
Thank you.
Your first question was, does Foundry invest in convertible debt? We've been talking about equity, me buying stock of your company. There are other ways of making investments. One's called a convertible note, which is basically debt where I'd give you $1 million and you owe me $1 million back unless you raise money later, then that $1 million converts into equity. Traditionally, there were two reasons for doing convertible debt. One, it was cheaper and easier than doing equity. You saved money on lawyer fees. That is pretty much changed now. They're pretty much the same price. And two, it avoids us having a valuation discussion. You and I don't have to determine what the valuation of the company is if we do debt. As a professional venture capitalist, like, if we can't talk about that, like, we got a bigger problem. So let's just figure this out. Let's figure out what the valuation is. If we can't agree, personally, it feels like for me that the relationship's starting off incorrectly if we're going to put $5, $6, $8 million in your company.
Great content here, guys.
Thank you.
The question I've got is,
Well, if you're going to repeat that, let's get the microphone.
Oh, God. No, so say great
mediocre
content,
guys.
Brad. Nice to see you too, Jason, is what you meant, right?
Singing Brad.
So, and this has evolved, I think, in a possibly negative sense. Want to get your impressions on it. As an entrepreneur here in Denver, I can think of one, possibly two VCs in the Denver Boulder community. For us entrepreneurs, how do we think about that? Where has that market gone? Is it coming back? Or do we look to the coasts or other?
So I can think of
investors?
6 off the top of my head that all do software in our space. So that's 6 is greater than 2.
Should we list them?
Huh?
Let's list them.
Okay, we got Access, we got Grow Tech, we got Boulder Ventures, we got us, Meritage.
Tango, High Country still?
Yeah,
investing?
Tango, High Country.
Okay, so that's 6 in the software.
And there's more. I'm sure I'm forgetting a couple. And there's tons of angels. I mean, Elizabeth runs an angel network. I mean, there's a whole bunch of stuff. Don't worry about it. So Boulder's always, even back in the heyday, back in 99, 2000, when there were a lot of firms around here, it was always importing 70, 80% of its capital. So don't worry. Boulder's no different than anywhere else. If you don't live in Silicon Valley, if you live in Silicon Valley, you can get 100% of your capital there. If you live anywhere else, including New York and Boston, Seattle and Portland and all these other cities, you have to import capital into those regions. Don't worry about it. It's all right. It happens. Oh, sorry. You're next.
Hi. So it sounds like the market's still kind of inefficient given the fact that 5,000 or more companies come to you guys and only 10 actually get funded.
Is that inefficient? You weren't an econ major, were you?
I
guessed
not.
that correctly, right. Okay, go ahead.
I feel like there's still a lot of room for opportunity. Do you think there is room for other intermediaries other than VCs to help this big inequity, I guess?
Well, first of all, I would disagree with the way you phrased that. It's not an inequity. It's not unfair that 5,000 companies don't get funded. Only the good shall survive. It's just kind of how it is. There's angel investors, there's micro VCs, there's crowdfunding. All these things are trying to get rid of this inefficiency. Do I think there's room for innovation? Hell yeah. Do I think that there's going to be something 3 years from now that none of us have considered that helps startups get funded? Heck yeah. But I don't know what it is right now. VC's been around a long time, and it'll continue to be around a long time, but it's changing a lot. I mean, it used to be. I remember when I started as a VC, I was like, "This is cool. I will never have to work August. I'll work 9 to 5, and I'll drive a Ferrari." So instead, I work my ass off. I haven't had a vacation day since July, including over the holidays, and I drive an Acura, and it's a nice Acura. And I'm not complaining. I got a great life, but it's different, and certainly the margin, as more VCs have come into the market, it's lowered correctly, by the way. For those of you who saw that wonderful Tom Perkins interview last night, I don't know. You should not count on me being a douchebag with an underwater submersible car underneath the Boulder Reservoir anytime soon. That's all I'll say. Airplane, yes, underwater airplane. I'm not sure what that means. Right.
I'll say one of the most interesting things to watch over the next 10 years from my vantage point is historically there's been a strong local bias both in angel and venture capital, which advantages companies that live in startup ecosystems and marginalizes or terrifically disadvantages those that are outside it. I think it's going to be fascinating in terms of crowdfunding and some of the other intermediaries, of which you could also include accelerators, as well as angel networks. And almost certainly there's been a lot of good ideas that have not been able to get funding because of location. And it'll be interesting to watch over the next 10 years whether crowdfunding, accelerators, and other intermediaries start to surmount that. Now, there's some real concerns as to how that's going to look. It's certainly not going to look like traditional venture capital in terms of the constraints and incentives. I think we're going to have to refigure out the contractual structure of it. But it's a fascinating question to watch.
There was one up in the gallery.
Yeah, you spoke to shopping term sheets around to multiple venture capital, and you also spoke about having to go to coast to get partial money. Can you speak any bit to anything with multiple firms?
Yeah, so the question is, if I'm an entrepreneur, should I be thinking about getting multiple venture capitalists in a round of funding? And the answer is depends. If you are a low burn, capacity, small, I'm losing my train of thought here. Low burn, and you're not spending a lot of money, and you're very cash conservative. Then, if you raise $3 million and you got 3 VCs to come in for $1 million, what's wrong with that picture? Well, there's too many cooks in the kitchen. First of all, you're going to have 3 VCs on your board. Vomit. Okay, so that's number one. Like, oh my God. But what's the bigger issue? The bigger issue is, remember the point I said I need to own a substantial amount of your company? Well, I may not own enough of your company to care. In the Silicon Valley, they call this a party round. It's like some hot entrepreneur and all the VCs chunk in $250,000 and nobody pays attention, nobody helps up, nobody's engaged. You come back and say, hey, look, it's ready for me to raise a new round. I've already moved on to the next thing. Now, that's on one extreme. The other extreme is you're going to do a hardware startup and you're going to do robotics and you're going to need to raise $100 million over time. maybe you do want to get a couple of VCs interested early to form a really a strong syndicate that can fund you through the life cycle of the company. So it really does depend. There's not one answer, but understand where the incentives lie.
Let's go back, sir.
Yeah, can you compare the business model of VC like Foundry to something like an accelerator, and kind of how the business model for those entities, and also how they differ operationally?
So
let's define an accelerator.
So first of all, the VC market, so the VC business model versus the accelerator business model is the question. What's the difference? Well, the VC is pretty simple, right? I got the money in, got to return more money back, and I got a timeline. We are generally, we've been around longer. We probably have more senior people because of what these things called management fees. Not only do I raise money, but I get to take some of that money to hire people. That management fee component is usually fairly healthy, so I can hire very professional folks. Accelerators, depending on where their money's from, they may have no time horizon. Awesome. Accelerators, on the other hand, though, are usually an up or out model, right? The whole idea of an accelerator is you get into it, there's some period of time, and then they say, fly, be free, for those of you old enough to remember Mork from Ork. Cool, a couple people are older than me. It's happening less and less these days. So the accelerator, from Boulder, right? Actually, David Cohen, the founder of Techstars, lived next door to Mork's house for a number of years. He just recently moved. Little trivia for you, those out there. But the accelerators, the idea is it's short period of time. They do get money in. It's up and out. The business model for them is they make money by taking equity off of all the companies and investing at a very, very low valuation and being very, very hands-on. And so they're going to do a lot more investments than I am. My Foundry may invest in 75 companies total over 3 funds. I mean, Techstars has probably got, 100 companies a year now. So they're doing a lot more. If one pops, it can pay for everything. It's just a very different model. They're very complementary. A good accelerator can be my best friend as far as deal flow and me being involved as a mentor and learning about the companies. As Brad talked about, there's these information gaps. And if I meet Norwood tonight and we have coffee and we fall in love and decide we want to date and then eventually go to a term sheet, with a company and accelerator, I could spend 3 months with them. I have a much longer time before I have to make a decision, so it helps reduce some of those information asymmetries.
Can I make one quick comment? So if you think about the traditional services in addition to capital that VC provides, the accelerator does a lot of this, and it's, as Jason said, complementary in that it's earlier stage, it can de-risk the company, help grow it, and really be a feeder for venture capital. That's version number 1. But if we combine that with the crowdfunding question, and you think about starting a company, I'll pick on Lincoln, Nebraska, where I'm from, where there's not a rich support network, if you're able to crowdfund...
Or any.
Yes. Well, if it's a football startup, you're going to be all right. But yes, you get the capital through crowdfunding, but what are you not getting? You're not getting a lot of the other services. It'll be interesting to see whether you see people start to mix and match a local accelerator along with other sources of capital in an unbundled sort of fashion. I think that's going to be fascinating if accelerators start to morph into something that, especially in certain locations, start to do that. One more question?
Let's do 2 more and then we're out of here. Okay. 1 and then 2.
I had a 2-part question. Hope that's okay.
Shit.
First part is just on the, how do you guys think about venture debt when you add it to a Series A or Series B deal and the pros and cons? That's the first part. Second part.
Can I just answer that one?
Okay.
Okay, keep going. Come on.
When do we get to see Legitimate Front play in Boulder again?
Kiss ass, but I love it. Thank you. First question is, I love venture debt from venture providers like Silicon Valley Bank and Square One. Reputable venture debt banks are awesome. These days with interest rates, it's like free money. So the answer is yes, 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 especially if you're doing anything with inventory. If your startup has goods or that it's selling, get venture debt to pay for those goods. Don't use your equity. Next legitimate front gig, I don't know. I took a little hiatus. I had hip surgery last year and came back a little too early on stage and did a face plant in Chicago. So I'm going to try not to do that. But we got the band back together. We're starting to practice again. So hopefully, keep looking on Facebook for legitimate front. And then there was a question in the middle.
I have always understood that if you're shopping equity, you're constrained by security.
Correct.
So when I'm going around to venture capitalists and trying to get
So the question is, I was under the impression that there was this thing called the 1940 Act and Securities Act that said I can't go out and sell securities without getting in trouble. There's rules. The answer is yes, except none of the rules apply to accredited investors like a venture capital firm. So you can shop us all day long. You cannot, although there are certain circumstances you can do that now, the rules that just changed for crowdfunding, but traditionally you've not been able to go sit up outside the parking lot, and as this group was leaving, you could say, please, I'm selling equity in my ice cream parlor. Although under certain circumstances you can do that now. But this is where a good lawyer is worth their weight in gold.
So that relates to the VCs, but then you've got these angels.
Same thing. Same thing. Any professional investor is going to be safe to talk to more or less under securities laws.
And as a rule of thumb, as an entrepreneur, think about if there's expectation of profit based primarily on the efforts of others, you are selling a security. Doesn't matter whether it's styled as stock, doesn't matter if it's convertible debt, those are all securities. And if you're in the business of raising a security round, as everything that we've talked about is, talk to a lawyer. This is an area that will get sideways if people lose money, and you want to be able to say clearly, this is the exemption to the security rules that we are using, and have that airtight, especially if a later investor comes in that want to make sure that you haven't blown securities laws already.
I got a question, since you're the lawyer here and I'm not anymore. You said that if you're selling something with a profit interest that's based on the work of others, you're selling a security. Is that correct?
Broadly, yeah, that's a
So then how the hell does CU sell college scholarships for athletes?
Sell some expectation. We got to rehabilitate the end. We got to find a nice way to wrap it up. What do you?
All right. Thank you very much for coming. We hope you enjoyed. Thank you for your support, too.